In this video, we'll be going over IRS Form 8854, Initial and Annual Expatriation Statement. This tax form is used by either U.S. citizens or long-term residents who have decided to relinquish their citizenship or residency on or after June 17th, 2008. The annual filing of IRS Form 8854 is used by expatriates not only to certify their continued compliance, but also the compliance with tax obligations for the 5 years prior to expatriation. So we'll walk through each of the parts of this form. In the case of our hero, John Doe, generally everyone that files has to file Part 1, and there are 3 parts to this. So Part 1 is the general information that everyone is required to file, and this mostly will stay the same with each subsequent filing. Part 2 is the initial expatriation statement for persons who expatriated in the tax year of filing. So in this case, 2023. And then in Part 4 is for everyone who expatriated prior to 2023, and it's their annual statement. So when you file this form, you don't have to complete all versions of it. You're going to complete Part 1, and then either Part 2 or Part 3 is applicable. For this demonstration, I will walk through all 3 parts just for visualization purposes. So we start at the top of the tax form with our hero, John Doe, and we've got his social security number, his mailing address. If he had a different address from line 1, he would put a second address in line 2. And in this case, he's decided to move to France. We've annotated that this is the initial expatriation statement. So he's prompted to complete Part 2. We'll go through Part 2 and Part 3 separately, but we just marked that. It turns out that John Doe was born a citizen. He was a citizen of the United States, but he also was a citizen of France when he was born. So he's both a French and U.S. dual citizen, and he's decided to move to his address in France. So if you list more than one country, you would then need to list the date that you became a citizen of each country in line 6B. So he checked off that he became a U.S. citizen by birth, and lines 8A through 8C are for lawful permanent residents only. So in Part 2, this is his first tax year, so he is having to declare his assets in addition to filing his income tax return because there is a part of the tax code, Internal Revenue Code section 877A, that basically forces persons to declare themselves as covered expatriates, and we'll explain that in just a minute. And if you're a covered expatriate in the year that you expatriate, then you are subject to income tax on the net unrealized gain of all of your property as if you sold it the day before you moved out. In other words, the federal government is going to require you to calculate your tax bill as if you sold everything out of your IRAs. If you sold all of your property, your investments, you're going to have to calculate a certain what that tax liability would have been. There are opportunities under the tax code to defer that tax so that you can unwind these properties over time, but you're going to have to keep track of that year after year. So this is known as a mark-to-market tax. There are certain items that the mark-to-market tax does not apply to. eligible deferred compensation, ineligible deferred compensation, specific tax deferred accounts, and then interests in non-grantor trusts. So if you own assets in any of these categories, you should probably walk through this with a tax professional. So in general, you are not considered a covered expatriate if your tax bill or if your net worth are below a certain threshold. So for 2023, the covered expatriate status applies if your average annual net income tax bill for the 5 years prior to the date of expatriation was more than $190,000. Not your taxable income, not your adjusted gross income, your tax liability. And then part two, if your net worth was $2 million or more on the date that you expatriated, or if you fail to certify on your Form 8854 that you've complied with all federal tax obligations to include filing required returns for the 5 years prior to your date of expatriation. So those are the general rules. And if any of those conditions apply, then you would be considered a covered expatriate. So let's go through section A. We'll walk through this with John Doe. So in this case, he's stated his income tax bill for the 5 years prior to his expatriation. And, he's had a pretty steady income. So for this purpose, he's consistently paid $10,000 a year in taxes. So he's well under the $190,000 average tax liability threshold. His net worth will actually be the net result of this line right here. So we're going to bring up line 25 of the part B. So net worth is $250,000. So we'll bring that up here, and we're going to walk through that in just a second. So his net worth is under the threshold, and line 6 is the line where he would certify that he has complied with all of his tax obligations. But let's go through questions 3 through 5. So question 3 is, did you become at birth a U.S. citizen and a citizen of another country? And if so, do you continue to be a citizen of and taxed as a resident of that other country? So in this case, John Doe was a French and U.S. citizen from birth, so he selected yes. If you selected yes to question 3, have you been a resident of the United States for not more than 10 of the last 15 years, including the year of your expatriation? So in this case, no, he's been a citizen of both, but this constitutes the status of long-term residency. So if you are a long-term resident, then you are subject to some of these additional, or you may be subject to some of these additional reporting requirements. Were you under age 18 and a half on the date that you expatriated? And have you been a resident for not more than 10 years? And the answer to that is no. But line 6, do you certify under penalties of perjury that you've complied with all of your tax obligations? And he answers yes in this one. So I'm going to circle back to section B for a moment, but for a moment I'm going to start with the top of section C, because there's certain items where you don't have to complete section C if any of the following apply. So we covered the criteria for the covered expatriate, which is your average net tax bill is $190,000 or less. Your net worth is under $2 million, and you checked yes, certifying under penalty of perjury that you're up to date on your tax obligations. So John Doe automatically does not have to cover or go through section C. However, he would also not have to go through section C if either this part where he said yes to lines 3, 4, and 6, or if he answered yes to lines 5 and 6. So if you remember, lines 3 and 4 were you a citizen at birth to both countries? And if so, have you been a resident for not more than 10 of the last 15 years? Or if he expatriated, as soon as he reached the age of majority or younger, and he was not a resident for more than 10 tax years. So either of those, or his current circumstance of not being a covered expatriate, would preclude him from having to complete Section C. So let's go to Section B, because he will have to report that as needed. So in this case, he doesn't have a whole lot of assets, but most of these are fairly straightforward. Some of these do require a look in the instructions. For the sake of this video, kind of steered away from all of those items that require additional instruction. So he's got $10,000 in cash, and he's got to list his fair market value and adjusted basis. So the adjusted basis for cash is the same as the amount of cash. For marketable stock and securities issued by U.S. companies, he's got stock worth $20,000. His basis is $10,000. He's got real property. He's got a house in the United States, and he's also got a house outside the United States. However, he bought them at roughly close to their current market value, so that represents why their basis is pretty much the same. And we've totaled those at the bottom here. He's got $330,000 worth of assets. He's got $320,000 worth of basis. So really, we're talking about a $10,000 gain, and that would be applied to any gain on his stock. So under liabilities, he's got $80,000 of a mortgage. So we net the difference between that right here, and we get $250,000. And that is the number that we put up here under line 2 of Section A. So the more complicated your situation, the more thorough your Section B is going to have to be. And then the fair market value versus the adjusted basis, that's what you would be calculating your potential tax liability on. So now under Section C, again, we're not going to complete this, but we will go over this because there are certain items. And again, these are items that you would have to declare if you were a covered expatriate, right? So eligible deferred compensation, ineligible deferred compensation, a specified tax deferred account, or a non-grantor trust. So you would check this box right here if you elected to be considered as if you received your entire interest in the trust, this non-grantor trust, as of the day prior to your expatriation. So you would have to have a valuation letter ruling issued by the IRS, and then you would be able to check that box. But basically, that's going to force you to realize quite a bit of income up front. Now, you would also have to enter in for each piece of property that you're talking about. You would have to, and you would have to enter a description, the fair market value on the day before expatriation, the cost or other basis. So let's just say we had a non-grantor trust, and let's just say it was worth $500,000 the day before, and let's just say everything in it cost $400,000. You have a gain of $100,000. Then you would have to calculate a gain after allocating the exclusion amount. So according to the form instructions, there is a certain exclusion amount that would apply, and basically if the gain of all gain properties exceeds the exclusion amount, then you would allocate the exclusion amount to the different properties. So in 2023, the exclusion amount is $821,000. And if you had multiple assets like XYZ and they happen to be the exact same, then hypothetically you would, apply the exclusion, and then let's just say that there's $50,000 left over after the exclusion, then you would have to allocate, 50-50 in this case, right? The numbers on the screen are obviously not reflective of the exclusion amount, because in a real situation, the exclusion amount would be, or the gain after the exclusion amount would be zero, right? But if you had to, you would allocate it based on the value of each of these assets listed. And then you would indicate the form or the schedule on which this loss or gain is reported. So it could be IRS form 4797, it could be IRS form 8949, depending on what it is. It could be Schedule D, whatever it is, you would indicate that on the schedule. And then if you're deferring tax for any property listed in column A, then you would complete column G, which lists the amount of tax that you're choosing to defer, and then you would have to include your calculations based on how you arrived at that tax deferral. So needless to say, we're not doing any of this for John because we don't have to. But then we would go down here, we would total all of these amounts, and then basically we're adding the column G amounts down here. We get whatever the amount would be for column G. So this is just a hypothetical because we're not actually having to complete this. So now John Doe has the right to elect to defer. However, he has to provide adequate security to the United States. So what is adequate security? Adequate security basically means that the federal government, for some reason, does not trust an IOU. Like, you can't just say, I'm going to pay you back as soon as I can, or I will keep filing my tax returns. You basically have to post a bond or some sort of assurance that allows the IRS to understand that you will pay your tax. So an adequate security can either be a bond that is furnished to and accepted by the IRS, conditioned on the payment of tax and meeting certain tax code requirements, or some other form of security, such as a letter of credit, that the IRS will accept. And then you need to correspond with the IRS office. There is an office listed in the form instructions that you can correspond with to work out the issue of adequate security. So again, this is only if you're electing to defer tax. As we realized up here, John Doe really is talking about a $10,000 gain. He's not going to defer that he's not going to defer the tax and go through the burden of trying to establish adequate security when we're talking about a $10,000 gain. So this right here is a hypothetical situation, because if you do defer, you still have to calculate your tax bill, basically what it would have been if you liquidated everything, and then what it would have been under normal circumstances. So in essence, you have to complete two different tax returns using two different sets of information. So imagine that you completed your Form 1040 as if you liquidated everything. You're not going to, but you calculated a tax bill of $75,000. And then you did the exact same thing without liquidating everything, but just with all of the normal tax events of the year, and you came up with a tax bill of $15,000. You would subtract one from the other. In this case, the 15,000 from the 75,000, and we're deferring $60,000, right? So then you go up to here, you pull the number of how much tax you actually did defer, and let's just say you deferred $30,000. There you go. So this is the amount that you would enter on your Form 1040 or your 1040 SR. In brackets, you would mark it EXP, but it would be right next to line 24, right? So your tax liability would be set aside on your Form 1040. And then in Part 3, we only do one or the other for John Doe. We did Part 2, and we did not really have to complete Section C, but we walked through that. Now we're going to walk through Part 3 as if John Doe was doing his annual expatriation. So if we just kind of forget everything that we previously reported, we're now focusing on Part 3 as if, he elected to defer payment of tax, right? So for line 1, he would enter a description of each property for which he deferred tax in a prior year. So in column B would be the mark-to-market gain or loss that he previously reported on the prior year 8854. Then in column C, it would be the amount of tax that he deferred on that. And then the date of disposition, if he actually disposed of that, would be in column D. So obviously the amount of tax and the amount of gain would not be the same. We're not in a 100% tax rate environment yet, but let's just say it was $2,500. That's probably a little bit more appropriate. So in Part 3, if he received eligible deferred compensation items, he would have to enter yes, the amount of distribution, the amount that he withheld, for tax purposes, and then same with any distributions from a non-grantor trust. So these would all be assets that would have been listed here, and he's going to list that here, and then he's going to sign these. And again, this is your annual statement, and you'll file that each year until you've completely liquidated all the assets that you said you did not, or that you deferred the tax on. So you must file Part 3 if you deferred the payment of tax on any property in a Form 8854 filed in a previous year, if you reported eligible deferred compensation, or if you reported an interest in a non-grantor trust. So if you've gotten to the point where you've stopped deferring all of your tax because you've paid it, and you're not reporting any eligible deferred compensation or an interest in a non-grantor trust, then you can stop filing 8854. So unless you're working with a financial planner that is well versed in working with expatriates, I highly recommend that you find an accountant or a tax preparer that specializes in that, because this can be a little bit tricky. And if you're moving overseas and becoming an expatriate, this is probably, on a very long list of things that you would need to accomplish before you pack up and leave an entire country. So this is probably one of the more difficult tax forms for someone who has never done this before. But if you're willing to do this on your own, then you would file this with your income tax return on or before the due date of your regular tax return. So that's all we have for this video. We'll put links to some relevant resources discussed either during this video or in our article. We'll put links to those resources in the show notes. And we do cover this in a little bit more depth in our article, which you can find the link to in the show notes, or you can go to our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8854, and this article should appear. If you like our articles, please subscribe to our newsletter. And if you like our videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there's a topic that you'd like to discuss in a future video, please hit me up in the comments section. Thank you very much and have a great day.